Hello and good evening. How are you? I hope you guys are doing well. Okay, so let's start today. We are again going to cover up the exam kit questions. So here we go. I have chosen the questions from the IAS 38 first. We'll do this and then we'll move forward. So, which of the following statements related to the intangible assets is or are true? All intangibles must be carried at amortized cost or at an impaired amount. They cannot be revalued upwards. Now, this statement over here is wrong. Why? Because the intangible assets, they may be revalued upwards using the revaluation model if the active market exists for the asset. Although this is kind of sort of unusual thing, but still they can be because the option is available. So this statement is going to be false over here. And then the development of the new process, which is not expected to increase sales revenue, may still be recognized as an intangible asset. Now, this statement is going to be true over here. The reason being, a new process may produce the other benefits, like, for example, reduced cost instead of increasing the revenue, new technological way by which the labor cost is like getting lesser or something, right? So therefore it can be recorded as, or it can be accounted for as an as an asset is concerned. Right now, a division of an entity has the following balances in its financial statements. It has the goodwill, plant, building, intangible under the net assets. Following a period of losses, the recoverable amount of the division is deemed to be 4 million over here, right? So after the losses, the recoverable amount of the division is standing at 4 million. Now, a recent valuation of the building showed that the building has a market value of 2.5 million. Okay. So recent valuation of the building shows that the building has a market value of 2.5 million over here. The other net assets are at their recoverable amount. The entity uses the cost model for valuing the building and plant over here. So to the nearest thousand, what is the balance of the building following the impairment review over here, right? So following the impairment review, basically what needs to happen over here is that, basically when it comes towards the cash generating unit, when it comes towards the cash generating unit, the impairment is basically charged to the whole unit instead of a one single asset or something, right? But still, in doing so, we have to ensure at the end of the day that no asset is reported or is impaired below its recoverable amount, right? So the valuation in the market of 2.5 million, this 2.5 million is an indication that the building, it has not been impaired. It has not been impaired, right? So as far as the building is concerned over here, we cannot impair the building over here in the cash generating unit because it is already stated at its carrying value over here, although you're not using the fair value. So you are gonna let it be there as it is, right? You are not going to change anything into, as far as changing the carrying value of the building is concerned, right? So our answer is going to be A over here. The building is going to be reported at its same value, which it already is. The reason being the carrying value is going to be, the recoverable amount basically of the building is still at 2.5 million. So we can simply say that it is not impaired over here. Right? Okay. Then we have a division of an entity has the following balances in its financial statements. We have the goodwill, plant, building, intangibles, and now the other assets. Following a period of losses, the recoverable amount of the division is deemed to be 4 million. A recent valuation showed that the building has a market value of 2.5 million. The other net assets are at their recoverable amount. The entity uses the cost model for valuing the building. To the nearest thousand, what is the balance on the plant following as far as the impairment review is concerned? So I'm gonna go over here. This is the goodwill. with the 700,000. Then I have my plant, building, intangibles, and other net assets. The plant has 950, 2,300,000, 800, and then 430,000. Now, the total carrying value is 5180. Recoverable amount is 4 million. So the impairment is 1180. The rule for the impairment is, first thing first, we are going to charge against it, nothing against over here. As far as the building is concerned, nothing against the other net assets as well. So we are left with the plant and the intangibles against which we have to charge the impairment over here. So the balance on impairment, that is going to be 700 charged against the goodwill. So we are left with 480. So over here against the plant, this is going to be 950,000 divided by intangibles and the plant. Only against these two we have to charge now. So this is going to 816 and 1750 multiplied by 480,000 over here. Right? So we will have this amount as the impairment, right? I'm going to cut it over here and I am going to paste it over here as the impairment for plant, right? So this is the what we are going to have. So I'm just gonna simply put it up over here, and this is going to be 950 by 1750 into minus 480,123. So that's gonna be 260,571 over here. So we are going to have the plant value at 689. So it's saying to the nearest thousand, right? To the nearest thousand. So we are going to round it off at 689,000 over here. So we are going to round it off at 689,000 over here. Done? Okay. Now moving ahead from here, then we have this question number 25 over here. A vehicle was involved in an accident exactly halfway through the year. The vehicle cost 10,000 and had a remaining life of 10 years at the start of the year. Following the accident, the expected present value of the cash flows associated with the vehicle was 3,400 and the fair value less cost to sell was 6,500. So what is the recoverable amount of the vehicle following the accident over here? The recoverable amount is basically the higher of value in use along with the net disposal proceeds over here. So the net disposal proceeds over here are 6,500. So the recoverable amount of the vehicle which we are going to have over here are going to be 6,500 over here. So 6,500 is going to be the answer over here, okay? Then moving ahead from here, we have 26 over here. The net assets of Fingal, a cash generating unit, are property, plant and equipment, allocated goodwill, product, patent, and the net current assets. As a result of the adverse publicity, Fingal has a recoverable amount of only 200,000 over here. So what would be the value of the Fingal's property, plant, and equipment? after the allocation of the impairment loss over here. So we have property plant, which is standing at 200,000. We have the goodwill standing at 50,000. We have product patent standing at 20,000. Then net current assets at 30,000. Total amount is 300,000. And then it says that the recoverable amount is only 200,000. So we have the impairment of 100,000. Against the goodwill, we are going to have this 50,000. So 50,000 is remaining. So this is the product patent only, nothing against the net current assets, right? So the product patent is for 200, property is for 200 over here. And we have to find the value of the property. So this is going to be, again, 200 by 220, right? 220 by 200 plus 20 is 220 multiplied by 50,000 over here, right? So the carrying value, which we are going to have, the revised value is going to be the sum of these two. So that's going to be 154,545 over here, right? So that's going to be 154 over here as an option A we are going to have. Okay, then question number 27 is going to be, which of the following is not an indicator of impairment? Which of the following is not an indicator of impairment? So we have advances in technological environment in which the asset is employed have an adverse impact on its future use. Technological environment, the advances have been there. So technically speaking, having an adverse impact, this shows that the asset is impaired. So this is an indication that the asset has been impaired. Then an increase in the interest rates, which increases the discount rate of an entity that it uses. This is an indication of impairment as well. The carrying amount of an entity's net asset is higher than the entity's number of shares in issue multiplied by its share price. So you have a higher value of asset than the net assets that you have, the net investment that you have. So yes, this shows an investment as well. This shows an impairment as well. Then D is the estimated net realizable value of the inventory has been reduced due to fire damage, although this value is greater than the carrying amount. So if the value is still greater than the carrying amount, right? The recoverable amount is still higher, or the NRV is still higher, this does not indicate an impairment over here. So we are going to go with the option D over here. Okay. Then we have question number 28 over here. Riley acquired a non-current asset on 1st October 20X9 at a cost of 100,000, which had a useful life of 10 years and a nil residual value. The asset had been correctly depreciated up to 30th September 20Y4. So on 20X9 1st October, the cost was 100,000, the life was 10 years over here, okay? So residual value is nil. Now, the asset had been correctly depreciated up till 30th September 20Y4. So at that date, the asset was damaged and an impairment review was performed. So on that date, the asset was damaged and impairment test was performed. On 30th September 20Y4, the fair value of the asset less cost to sell was 30,000. Okay. And the expected future cash flows were 8,500 per annum for the next 5 years. The current cost of capital is 10%, and a 5-year annuity of $1 per annum at 10% would have a present value of 3.79. So what amount would be charged to the profit or loss for the impairment of this asset for the year ended 30th September 20Y for the amount to be charged to the profit or loss for impairment. Now, if you look over here, 100,000 is the cost at 20x9. Asset has been correctly depreciated up to 30th September Y4. So first thing first, we have to calculate the carrying value of asset over here, right? In order to calculate the carrying value of asset, we are simply going to check how to calculate the carrying value. For this, we are simply going to have its cost 100,000 divided by life of 10 years, and then we are going to multiply it. We got it on 1st October 20x9. First year end is going to be y0, y1, 2, 3, 4. 5 years have gone over here, right? So we are going to multiply it with 5 years to get accumulated depreciation. So that's going to be 50,000 over here. So the carrying value is going to be 100,000 minus 50,000 at 50,000. Now, the recoverable amount is the higher of value in use and net disposal proceeds. If we see the net disposal proceeds, the fair value less cost of sale was 30,000. And then the value in use, it's 8,500 per annum for the next 5 years, and the annuity factor is 3.79. So 8,500 into 3.79, we get 32,215. So recoverable amount is going to be this one over here. So impairment charge is going to be 50,000 minus 32,215. That's going to be 17,785 over here, right? So we are going to have this 17,785 over here as the impairment charge over here. Then we have this question 29 over here. Metric owns an item of plant which has a carrying amount of 248,000 as at 1st April 20x3. It is being depreciated at 12.5% per annum on a reducing balance basis. So on a reducing balance basis, the plant is being depreciated. Now, the plant is used to manufacture a specific product which has been suffering a slow decline in sales. Metric has estimated that the plant will be retired from use on 31st March 20x7. So the estimated net cash from the use of the plant and their present values are calculated over here. Now on 1st April, Metric had an offer from a rival to purchase the plant for 200,000. Now these are the present values over here. This is the disposal proceeds. So technically the recoverable amount is going to be higher of these two. So this 214,600 is going to be the higher amount, okay? The recoverable amount. So at what value should the plant appear in the metric statement of financial position at 31st March 20x4 over here? Okay, now we have this value at 31st March 20x7. This is the cost over here, the carrying amount basically over here is 248 on 1st April, right? So we need to have 1st April 23. This is going to end on 31st March 20x4. Then we have 31st March 20x5. Then we have 31st March 20x6. And then we have a 31st March 20x7. Now, 4 more years have gone by, right? 4 more years have gone by. Now, I'm going to show you this one trick over here that you can use, and that is 248,000, 12.5% reducing balance method. This is right. But I am going to give you a tip over here. And this tip is something which we are going to use over here in the context of where you have this 2-mark MCQ. So you can use this shortcut, right? This is 12.5%. You get the depreciation charge for 1 year specifically, right? This is the reducing balance method, right? But I am going to multiply it with 4 years straight away over here. I am not going to waste time in calculating the depreciation of the 4 years over here. I'll simply just multiply it. 248,000 into 12.5% into 4 years. This is 124,000, right? This is 124,000. So estimated carrying value is going to be 248,000 minus 124,000 is going to be 124,000. So that is way less amount. That is way less amount over here, right? So, so this is a way less amount over here, right? So overall speaking, this is one way to check that after this time period, this is going to be standing on this amount now. So if I look, this is 248 now. After that, it's going to be carrying at this amount. So this is the amount. This is when I compare, this is going to be the recoverable amount over here, right? So this is the recoverable amount, which now I have to compare with this carrying value over here, right? So this recoverable amount is lower over here than the carrying value. So technically speaking, the carrying value is on the higher side. So it's an impairment. So out of these two, the best value is going to be 214,600 over here. So the best value is going to be 214,600 over here. And this is going to be the one that you have to take up over here as a, recoverable amount to be reported in the accounts. Okay. Now we have question number 30 over here. I'm just going to start it in 1 minute only. So we have this question over here. As at 30th September 2023, the value of the dues property in the statement of financial position comprised cost 45 million, useful life is 15 years, and accumulated depreciation so far is 6 million. Then on 1st April 2024, that is exactly 6 months after, Dean decided to sell the property. The property is being marketed by a property agent at 42 million, which was considered a reasonably achieving price at that date. The expected cost to sell the property has been agreed at 1 million. Recent market transactions suggest that actual sale price achieved for this type of property in the current market conditions are 10% less than the price which they are at which they are marketed. So at 30th September, the property has not been sold. So at what value the property should be reported in Dune's financial statements or the statement of financial position at 30th September 20x4 over here. Now, the property is currently marketed at 42 million, right? But overall speaking, it is said that the property is normally sold at 10% lesser value over here, right? This is kind of sort of reported at 10% lesser value. This is one side of the story. And then the next point is we now have to show that at what amount should it be reported. Now, what we are going to do is let's have the property value cost at start, which is at 45 million. Depreciation for first 6 months. So that's gonna be useful life is 15 years now. So this is going to be 45 million by 15 into 6 by 12. So we are going to have this 1.50. Then accumulated depreciation brought forward is going to be 6 million. So carrying amount at this date is going to be at 37.5 million, right? So carrying amount at the moment is going to be at 37.5 million. Now, the fair value less cost to sell. The fair value less cost to sell, which we have at the moment over here is 42 million, right? That is 42 million less 10% lesser price. So that's 42 into 10% over here. Then we have less cost to sell. So cost to sell has been agreed at 1 million. So the NRV is going to be at 36.80. So the lower amount, 36.80, reported at 36.80. Right? So reported at 36.80 over here. Done? Okay. Now, moving ahead from here, now we are going to have another standard over here, and this is where we are going to start with as far as the leases are concerned. So the first question is, during the year ended 30th September 2024, Hyper entered into the 2 lease transactions. And 1st October 23, Hyper made a payment of 90,000, being the first of the 5 equal payments, annual payments under a lease for an item of plant. The lease has an implicit interest rate of 10%, and the present value of the total lease payments on 1st October 20x3 was 340,000. This is number one. Then on 1st January, Hyper made a payment of 18,000 for a 1-year lease on an item of equipment. Okay. So what amount in total would be charged to hyper statement of profit and loss for the year ended in respect of the above transaction? Okay, now, as far as for the first one is concerned, we have made a payment of 90,000 being the first of the 5 equal annual payments over here. Okay. And the lease has an interest rate of 10%. And the present value of the total lease payments on 1st October 23 is 340,000. Right? So we are going to have the depreciation charge over here first, which is going to be 340,000 over here as the present value of the total lease payments. So we are going to divide it with the 5 years to get the depreciation charge. So this is 340,000 by 5. That's going to be 68,000 over here. Then the finance cost, that is going to be, we have already paid this 90,000, right? This 340,000 is balancing amount. So 340,000, this is the total amount, sorry, not the balance, but the total amount is 340. From this, we are going to minus the 90,000 and then we are going to multiply it with the 10% the interest rate. And this is at exactly at the start of the year, right? So this is going to be 340,000 minus 90,000 into 10%. That's going to be 25,000 over here, right? So finance cost is going to be 25,000 over here, right? And then for the property 2, we have the rental of equipment over here. Why equipment? Because rental of the equipment over here. That is 18,000 for a 1-year lease, and we have done it on 1st January. Year end is 30th September. So it's been 9 months. You have paid the rent for the 12 months. So 18,000 by 12 into 9 is going to be 13,500. So the total payments that we are going to have over here are 106,500. So that's going to be 106,500 over here, right? Then we have this 78 over here, which says Z entered into a 5-year lease agreement on 1st November 20x2, paying 10,975 per annum commencing on 31st October 20x3. The present value of the lease payments was 45,000 and the lease interest rate is 7%. So what is the amount to be shown within the non-current liabilities at 31st October 20x3? Present value of the lease payment is 45,000, interest rate is 7%, and the amount is to be paid on the year end over here. Okay, so at the end of the year, you have to pay the amount, okay? So we are going to have the number of years, liability at start, interest. We have total, we have repayment, and then we have liability at year end over here. So first year end is going to be 31st October 20x3. Liability at start is the present value of the lease payments is 45,000. So the interest rate is 7%. So we are going to have a total of 48,150. The repayment is going to be 10,975. So the liability at year end is going to be 175 over here. Then we have 31st October 20x4. This is going to be the amount over here. This is going to be total. This is going to be interest. This is going to be total. This is going to be repayment. And then this is going to be the liability at year end. So the total liability still outstanding is 28,802. So this is what we are going to have as our answer over here. right? Then we have 79 over here, which is IFRS 16 leases permit certain assets to be exempt from the recognition treatment for right of use assets over here. So which of the following assets that we have following assets leased to an entity would be permitted to be exempt over here? Okay, so what assets can be exempt over here for the recognition of the right of the use asset over here? Okay, so number one is a used motor vehicle with original cost of 15,000, current fair value of 700, lease for 24 months. Okay, it has been leased for 2 years over here, current fair value is just 700 over here. Okay, then a new motor vehicle with a cost of 15,000, lease for 24 months over here. So you're leasing it for 2 years over here, right? So the time period is on the higher side. So you can record a right of use asset over here. Then a new motor vehicle again leased for 24 months. This is a higher period as well. So it's going to be recognized. Option D is a new motor vehicle with a cost of 15,000, leased for 12 months over here. 12 months, right? So this is something where you can skip it and you can simply record it as a lease rental over here, and then you won't have to record it as your liability. You won't have to record it as your liability over here. Then we have question number 80 over here. On 1st January 2023, Rabbit acquires a new machine with an estimated useful life of 6 years under the following agreement. Initial payment is 13,760, payable immediately. 5 further annual payments of 20,000 will due commencing from 1st January 2023. So you have straight away paid one deposit amount, and now you have to pay the annual lease rental as well. Interest rate implicit in the lease is 8%, the present value of the lease payment, excluding the initial payment, excluding this initial payment. This initial payment is going to be 86 to 40 over here. So what will be recorded in the financial statements at 31st December 20x4 in respect of the lease liability over here? Okay, so we have number of years, liability at start, we have repayment, we have revised balance, we have interest, then we have total. So here we go. First year end is going to be 31st December 20x3. Liability at start, excluding the initial this amount that we have paid, is 86 to 40. Repayment is 20,000. The revised balance is going to be the sum of these two. Interest rate is 8%, so this into 0.08, and the total is this one. Then we have 31st December 20x4 over here. This is going to be over here. Repayment is going to be over here. Revised balance is going to be over here. Interest is on here. And then we have this total again over here as well. Okay. Now, we have to find the finance cost to be included in 31st December 20x4. So this is for the x4, so we have to make one more over here as well. And this is going to be the same over here. Same over here, same over here, same over here, same over here. Now, what will be recorded in 20x4 over here? X4. Finance cost. This is 20x4 over here. So if I see this is my interest amount and that is going to be my 4123 over here. So I just have this finance cost of 4123 over here. This is going to be my option A over here. No need to see anything else because I don't have this 4123 anywhere else, right? So this 4123 is going to be my answer. Then over here, the non-current liability is 35. Why? Because and this is the current liability over here. This is the current liability of 20,000. My finance cost, this 4123, this is recorded over here, right? This is going to be my non-current liability over here, the revised balance done, and the difference between the two, these are going to be my current liability. This is the current liability balance over here as well, right? So this is how I am going to have it over here. Done? Okay. Now moving ahead from here, let's see, what do we have next? '81 on 1st April. Okay. On 1st April 2007, Pigeon entered into a 5-year lease agreement for a machine with an estimated life of 7 years. Which of the following conditions would require the machine to be depreciated over 7 years? So the life is 7 years and the lease agreement is for 5 years. Now, this is where the title of the machine is going to be transferred at your name at the end of the lease, right? Where normally the title is transferred at the end of the lease, over there you divide it or you depreciate it over the life of the asset, the higher side, basically. Right, so this is what you are going to see over here. Pigeon has the option to extend the lease for 2 more years at the market rental rate. No. Pigeon has the option to purchase the asset at the market value at the end of the lease. No. Ownership of the asset passes to Pigeon at the end of the lease term. Yes. The ownership is transferred at the end of the lease. So this is going to be the option C over here. Right? Then we have this 82 over here. On 1st January 2024, Badger entered into a lease agreement to lease an item of machinery for 4 years with rental of 10,000 payable annually in arrears. This is a 4-year lease for 10,000 payable annually in arrears. The asset has a useful life of 5 years. And at the end of the lease term, legal ownership will pass to the Badger. Okay, so the ownership is going to be transferred. So we are going to have this as for the 5 years over here. Now, the present value of the lease payments at the inception of the lease was 635,000. Okay. And the interest rate implicit in the lease is 12.2% over here. So the interest rate implicit in the lease is 12.2% over here, right? And fair value or the present value of the lease payment is 635,000 over here. Okay. Now, for the year ended 31st December 2024, Badger accounted for this lease by recording 10,000 as an operating expense. This treatment was discovered during X5 after the financial statements for X4 had been finalized. So in the statement of changes in equity for the year ended 31st December 2025, what adjustment will be necessary to the retained earnings brought forward? To the retained earnings brought forward, what should be the necessary adjustment that you have to do? So basically, you charged whole of the amount to the operating expenses. Because they are accounted for this lease by recording a payment of 210,000 as an operating expense, right? So, in statement of comprehensive income of previous year, operating expense of 210,000 is charged. What should have been charged? This is what you have to see. One is a depreciation charge, one is a finance cost. Depreciation charge would have been, with rentals of 210,000 payable in arrears, the asset has a useful life of 5 years and the present value of the lease at the inception of the lease was 635,000. So 635 by 5. 635,000 by 5, you have a depreciation charge of 127,000. So this was supposed to be charged over there, right? Second thing is the interest for the finance cost that should have been charged. So the 210,000 is payable in arrears. So at the start, we had this amount over here, 12.2% is over here. So 635,000 into 12.2%, this was supposed to be charged over there as well. So total charge should have been of 204 over here. Total charge should have been of 204, but you have charged 210,000. So we are going to have extra charge that has to be reversed or credit in retained earnings, and that is going to be 210,000 minus 204, 470. That's going to be 5530 over here. So I will have this 5530 as a credit over here, right? So I will have this as a credit over here. Done? Okay, I hope it's clear. Now, moving ahead from here. 83. All leases an asset with an estimated useful life of 6 years for an initial period of 5 years and optional secondary period of 2 years during which a nominal rental will be payable. The present value of the initial lease payment period is 87,000. So what will be the carrying amount of the right of use asset in our statement of financial position at the end of the second year of the lease? At the end of the second year of the lease, right? Okay, so useful life is 6 years, initial period is 5 years, right? And then you are extending it for 2 more years as well now. So total period is going to be your 7 years over here, whereas the life of the asset is 6 years over here. So the life is shorter over here. So what you can simply do over here is cost of the asset is 87,000. And the present value of the initial lease payment period is 87,000, and the life is going to be the shorter one, which we have to take over here is 6 years. So 87,000 by 6, we are going to have 14,500 over here. So the carrying amount, if we want to report, is going to be 87,000 minus 14,500. So we get 72,500 over here, right? So 87,000. And this is going to be in the second year, sorry, my bad. This is for the first year, my bad. And this is going to be 14,500 minus 14,500. Okay. So 87,000 minus 14,500, 14,500 is going to be 58,000 over here. Right, so the total amount, it's going to be 58 thousand over here that we need to take into account over here. Done? Okay. Then we have this question 84 with us. On 1st January 2026, Sideshow sold a property for its fair value of 2 million, transferring title to the property on that date. Sideshow then leased it back under 5-year lease, paying 150,000 per annum on 31st December each year. The present value of rentals payable was 599,000, and the interest rate implicit in the lease was 8%. The carrying amount of the property on the 1st January 2026 was 1.6 million, and it had a remaining useful life of 20 years. What entries would be made in the Sideshow statement of profit and loss for the year ended 31st December 2026? Now, it has sold a property for a fair value of 2 million, transferring the title of property on that date. So the Sideshow lease it back again over the 5-year period, paying 150,000 per annum on 31st December in 8 years. Now, the present value of the rentals payable was 599. Interest rate is 8%, and the carrying amount of the property on 1st January was 1.6 million. It had a remaining life of 20 years at that time. So, what entries are to be made? I am going to, overall speaking, talking about this one, the carrying amount of the property is 1.6 million over here, right? So you have sold it for 2 million over here, right? So let's see now. I am going to debit, my bank over here with 2 million. This is going to be debit. This is going to be credit. So my bank, it has to be debited with 2 million because I have sold this up. Then I have leased it back. The present value of the rental payable was 599,000 over here. So this is my present value of the lease liability, right? This one 599. So, okay. This property plant derecognized is going to be of 1.6 million over here. This is going to be derecognized, right? And the property plant to be accounted for is going to be, the present value was 599. Okay. So I will have to see the amount which has been sold actually and the amount which has been retained over here, right? So for that, I have to now do the calculations that how much of the value of the asset has been disposed of and what value am I retaining over here, right? So if I go, this will be done because in this way that the total life is the 20 years and I've just leased it back so that for the 5 years. So technically speaking, the control has been transferred to as far as the purchaser is concerned, right? So now I will have to calculate the initial liability, which I have to record over here, and the initial liability will be recorded with 599,000, the present value of the rentals over here, and this is going to be I have to record at the present value, which is going to be 599,000. Look, this is 599,000 divided by the property value is 2 million for which it has been sold, multiplied by the carrying value over here, right? Because I am going to look at the amount of the property that I have retained the right with me. So this is the value over here now, 599,000. It says the present value of the liability because the fair value of the asset acquired is 599. Divided by the 2 million is the carrying value, and then multiplying it with the 1.6 million, which was the actual, no, sorry, this 2 million is the disposal value. This is the carrying value over here, right? So we are going to have 599 by 2000 into 1600. So I have this 479 over here. So 479,000 is going to be recorded over here. Okay, so let's see. This is 479,200. This is what I was looking for, right? So 479,200 is going to be recorded as a property. 1.6 is going to be de-recognized over here. And then I have my lease liability as well. And the lease liability is 599 over here. And then I will have the P&L figure over here as a balancing one. So if I do, the total is this, and over here the total is this. Okay, so technically I have this total lesser on this side. So this is going to be 247,9,200 minus 219,9,123. 280,200. 280,200 is going to be my balancing figure over here as a profit on disposal over here. Okay. 280,200 is going to be my profit on disposal over here. This is what I am going to have. So profit on disposal 280,200 is okay, option N, D over here as well. So this is going to be 280,200 over here, and then it's asking for the depreciation over here and then the finance cost over here as well. Okay. So basically this is the profit element which I have calculated. Now I have leased it for 5 years, so my depreciation charge is going to be 479,200 by 5 years, right? Because this is the property value on which I am going to calculate as far as my depreciation charge is concerned. So that is 479,200 by 5. I get 95,000, this 840 over here. And then the finance cost is going to be the amounts are payable on 31st December. My lease liability is at 599,000 and the interest rate is 8%. So 599,123 into 8% is going to be 47920 over here. So 47920, this one, this finance cost is over here as well. Option A is the correct one. Option A is going to be the correct one over here, right? Profit on disposal, then the depreciation, and then the finance cost is over here, right? Okay. Then moving ahead from here, I have question 85 over here. On 1st October 23, Fresco acquired an item of plant under a 5-year lease agreement. The agreement had an implicit rate of 10% and required the annual rentals of 6 million to be paid on 30th September each year for 5 years. So the present value of the annual rental payment was 23 million. So what would be the current lease liability in the Fresco's financial position at 30th September 20x4 over here? Current lease liability over here. Okay. So this is 5-year lease agreement. Okay. So I have number of years liability at start, the present value paid on 30th September. So this is at the year end. Now I'm going to have the interest, total, repayment, and then liability at year end. So first year is going to end on the 30th September 20x4. My liability at start is 23 million. My interest rate is 10%. My total is the sum, and my repayment is 6 million. And then the liability at the year end is this one. Then I have 30th September 20x5. So this is going to be the balance over here. This is going to be the interest over here. This is going to be the total over here. This is going to be the repayment over here. And then this is going to be the liability at year end over here. Now I have to find the current liability balance. So this is going to be 19,303 000 minus 15,230 000. So I get 4070 as my current liability, because the difference between the two is my current liability over here. Right? So the difference between the two is basically going to be my current liability. Then I have this 86 over here. Which of the following would not be included within the initial cost of a right of use asset? Installation cost is capitalized. Estimated cost of dismantling is capitalized. Payment made to the lessor before the commencement of the lease are capitalized. Total lease payable, lease rental payable under the lease agreements. No, it's not capitalized. We capitalize the present value. Present value of the lease payments is what we capitalize. So this is wrong. This is going to be option D over here. Then we have the 87 over here. On 1st January 20x4, stock entered into a sale and lease back of its property. When it was sold, the asset had a carrying amount of 6 million, remaining life of 10 years. Stock sold the asset for 7 million and leased it back for 10 years lease, paying 1 million on 31st December each year. The lease carried an implicit rate of 7%. So what is the total expense that should be recorded in the statement of profit and loss for the lease? Now, overall speaking, if we talk about this particular question over here, as the company has retained the control of the asset over here, the asset cannot be treated as sold because it had a life of 10 years. So it has been leased back for 10 years. So the control is over there, right? So basically, it's just going to be regarded as a secured loan over here, right? So we are going to do those entries, and the entries are going to be one related to the depreciation charge over here, and the depreciation charge is going to be 6 million is the asset, life is 10 years, we are into the thousands, right? So 6,000 by 10 years is 600. The finance cost 7 million, 7%. So that's going to be 7,000, 7%, 490. So total charge 1090 over here. This is what we are going to have over here. Okay. Then we have 88. Viking issues 100,000 5% loan notes on 1st January 2084, incurring cost of 3,000. These loan notes are redeemable at a premium, meaning that the effective rate of interest is 8%. So what is the finance cost? So what is the finance cost to be shown in the statement of profit and loss for the year ended 31st December 20x5 over here? So loan notes have been issued. Okay. Incurring cost is 3,000. So we are again going to have number of years. Then we have the liability at start, interest, total, repayment liability at year end. So we issued in on 1st January 20x4. So this is going to be December 20x4. Liability at start is going to be issue cost is 3,000 over here. So 100,000 minus 3,000, it's going to be 97,000. 8% is the effective interest rate. This into 0.08, this is going to be total over here. The repayment is 100,000 into 5%. That's a 5,000, so the liability at year end is this one. Then we have December 20x5. This over here. And then same story moves now. So the finance cost for the second year. So the interest is 7,981 over here. The option B over here, right? Now, the next questions which we are starting over here are going to be from the revenue. But let's just have a break of 4 or 5 minutes or so. We're going to come back and then we are going to start. Let's have a break. Okay, so let's assume now. Now we have this question 107 over here. Lockheed sells machines and also offers installation and technical support services. The individual selling prices of each product are shown below. We have the sale price of the goods over here. We have the installation and then the 1 year service over here. And then Loki sold a machine on 1st May 20x1, charging a reduced price of $100 over here, including the installation and 1 year free service, 1 year service as well. Loki always offered discounts when the customer purchases a package of the products together. Now, according to IFRS 15, the revenue from contract with the customers, how much should Loki record in the revenue for the year ended 31st December 20x1 over here? Okay, so if we look over here, we have the sale price of goods, 75, installation, 30, 1 year service with 45. So the total balance that we have over here is 150 over here, right? Now, you have sold it at a price of 100 over here, right? So the amount that you are going to record over here is going to be, if I look, this is going to be 75 by 150 into 100. This is going to be 30 by 150 into 100, and this is going to be 45 by 150 into 100 over here. So 75 by 150 into 100 is 50. 30 by 150 into 100 is 20, and then 45 by 150 into 100 is going to be 30 over here. So the total revenue recorded is going to be, this is 45. Yeah, this 45 is going to be, this is 30 over here, right? Okay, so 30 over here. So now 1 year service is what is provided and has sold the machine on 1st May. The year end is 31st December over here, right? So January, February, March, April, 4 months are not included over here. So this is going to be 50 plus 20 plus 30 into January, February, March, April, 4. So 8 by 12 is what we are going to have over here. So this is going to be 50, 20, and 30 into 8 by 12. So we get the 90 over here because the service has to be time apportioned over here. So the revenue recorded is going to be the 90 over here, right? Okay, then we have the 108 over here. Place the following steps for the recognition, for the recognizing the revenue in order in accordance with IFRS 15. Okay, now first thing first, we have to have the identify the contract, number one. Number two is going to be identify the separate performance obligations within the contract. This is going to be the number two over here. Then the third point is to determine the transaction price over here. Then allocate the transaction price to the performance obligation is going to be over here. And then record the revenue over here. The hierarchy, the 5-step approach that we do. Right? So this is how we are going to take it up over here. Then we have this 109. BL entered into a contract with customer on 1st November 20x4. The contract was scheduled to run for 2 years and has a sales value of 40 million. BL will satisfy the performance obligations over time. So at 31st October 2025, the following details were obtained from the BL records: cost incurred to date, estimated cost to complete, and the progress. Applying the IFRS 15 rules, how much revenue and the cost should be recorded or recognized in the statement of profit and loss for the year ended 31st October 20x5 over here. So we have the price or the contract revenue, and the contract revenue is going to be the 40 million over here, right? Now, less cost to date is 16. Cost to complete is going to be 18. So overall profit is going to be 6 million over here, right? Now, we are going to have the percentage of completion, and the percentage of completion is okay, so progress billing or the progress percentage completion is 45% over here, right? Okay, now the revenue automatically 40 into 45% is what we are going to have over here. That's going to be 18. Cost of sales, that's going to be the cost to date. So recognized profit is going to be the 2 million over here. So the revenue is 18 million, the cost is 16 million. So we are going to have the option C over here, right? So the correct option is going to be the option C over here. Then we have this 110 over here. Malik is construction is a construction business recognizing the progress based on the work certified as a proportion to the total contract value. Malik will satisfy the performance obligation over time. The following information relates to one of its long-term contracts at 31st May. Malik's year end. That is Malik's year end. So we have the contract price, cost to date, then estimated cost to complete, invoice to customer, and the work certified. So what profit should appear in Malik's statement of profit and loss in respect of this contract over here? Okay, so we have for the 31st May 20x4 over here. So we have revenue to date, that is the work certified over here. That is work certified to date is 180,000. We have the cost of sales, that is cost to date, which has been at 135,000 over here. So profit to date, which has been earned, is 45,000 over here, right? With this 45,000 already recognized is the profit of 15,000 is already recognized. So the current year profit is going to be 30,000 over here, which is going to be my answer over here. Then I have 111 over here. Which of the following items has correctly been included in Hatton's revenue for the year ended 31st December 20x1? Has been correctly included. This is what I have to find. 2 million in relation to a fee negotiated for an advertising contract for Reese, one of the Hatton's client. Hatton acted as an agent for the deal and is entitled to a 10% commission. Okay. This is a fee and you are entitled for a 10% commission over here. So you can't have this 2 million over here. So this is wrong. We can't have it into the revenue. Then the B is 500,000 relating to the sale of a specialist equipment on 31st December. The full sale value was 700, but 200,000 relates to the servicing. That Hatton will provide over the next 2 years. So Hatton has not included that in the revenue in this year. True. This is correct. This is a correct treatment over here. Let's see the other ones, but this one is, it seems to be correct over here. 800,000 relating to a sale of some surplus land owned by the Hatton. This is a disposal. This is not something that we include into the revenue. 1 million in relation to the sale of a new customer on 31st December. Control passed to the customer on 31st December. The 1 million is payable on 31st December 20x3. We have not included the present value over here. We have not included the present value over here. So this is wrong over here. So I guess the correct option should be this option B over here. Now we have 112 over here. 112 is Sugar has entered into a long-term contract to build an asset for a customer here. Sugar will satisfy the performance obligation over time and has measured the progress towards satisfying the performance obligation at 45% at the year end. So the price of the contract is 8 million. Sugar has spent 4.5 million to date, but the estimated cost to complete are 5.5 million. To date, the Haver has paid Sugar 3 million over here. Okay. So what is the net liability that should be recorded in Sugar's statement of financial position over here? Now we have to record the net liability. For this, we will have to calculate that what do we have overall position of the contract. So the contract price is, the price of the contract is 8 million. Right? Let's just have it into the thousands because the answer is in thousand, right? Less cost to date, 4.5 million. Cost to complete, 5.5. So we have estimated loss over here of 2 million over here. One thing. Right now, if we have this 2 million, so it means in the statement of profit or loss, the recognized revenue is going to be 8 millions. How much work has been completed? 45%. So that's going to be 3,600. Cost to date is 4,500. And then we have the remaining loss that we have to take up over here. Basically, this whole loss has to be recognized. Huh? So 3,600 minus 4,500, 900 is already recorded. Remaining loss is going to be the 1,100 over here, which we have to record, right? So total loss which has to be recorded is going to be the 2 million, which we have to show straight away. Straight away the loss is recognized, right? Now, the contract liability is going to be revenue recognized, 3,600. With this, we have the amount received. How much have been received? 3 million. Then we have the provision for loss, that is 2 million. So we are going to have a contract liability over here. Sorry, provision for the loss is 1,100, my bad. So 500 is going to be my contract liability, which I have to show over here, right? Okay. Then moving ahead from here, we have this 113 over here. Rattan commenced a contract to build an asset for a customer in the year ended 30th September 20x4. The contract price was agreed at 1.5 million and the total expected cost of the contract are 800,000. Rattan will satisfy the performance obligation over time. The following figures were correctly recognized in the statement of profit and loss for the year ended 30th September 2024. We have the revenue, we have the cost of sales, we have the profit, And then the following figures are also relevant in relation to this contract work certified in X4 and in X5. So rather than recognize the progress on the basis of the work certified compared to the total contract price. Okay. So what should Redden include in the statement of profit and loss in respect of the revenue? In respect of the revenue over here. So we have work certified compared to the total contract price over here. So these are the amounts which have been recognized over here. So technically speaking, 1050 minus 450. That's going to be 600,000, option A. This is what we are going to have over here as far as the amount for the revenue is concerned, because in X4 the revenue was 450. Now the work certified to date is 1050, right? And the total. So the difference 450 of the revenue is already recorded. This year the total work complete is still 1050. So technically the balancing amount is going to be the whole revenue which you have to record in the current year. So that's going to be 600 over here. Then we have this 114. Sayer entered into a contract to construct an asset for the customer during the year and identified the performance obligation as one which is satisfied over time. So I recognize the progress towards the completion using an input method based on cost to date compared to total costs. The following information is relevant to the contract over here. So we have the contract price, cost to date, estimated cost to complete over here. Then the work invoice is 600,000. So what is the total value of the contract asset? Contract asset that we have to record over here. So I'm going to go with the contract price, 1 million. We have contract cost over here. 5 plus 3 is going to be 800,000. So estimated profit is going to be 200,000 over here. Then we have the progress. That is the percentage of completion over here. So that is going to be 500 by 800, because it says cost to date progress related to completion is calculated via the cost to date compared to the total contract cost. So 500 by 800 is what we have over here. So in terms of percentage, this is going to be 62.5% over here. So my revenue, it will be 625,000 less amount billed 600,000. So we are going to have the contract asset at 25,000. So this is going to be our answer over here. Then we have this. Hindberg is a car retailer. On 1st April 20x4, Hindberg sold a car to Letley on the following terms. The selling price is 25,300. Letley paid 12,650, half of the cost on 1st April, and the remaining payment of 12,650 on 31st March 2026. That is 2 years after the sale. Letley can obtain the finance at 10% per annum. So what is the total amount which the Hindberg should credit in the profit or loss in respect of this transaction in the year ended 31st March 20x5, right? So we have total amount of the car 25,300, amount received 12,650, and the balance is 12,650, right? Now with this 12,650, we are going to have its present value over here. That is 12,650 into 1.1 whole raised to power minus 1. That's going to be 11,499 over here, right? Or 11,500 technically speaking is going to be over here. So with this, we can have this 12,650 plus 11,499. So that's going to be 12,650 plus 11,499. 24,150. This is 150,149. Okay, rounding of error. That's going to be option D over here because we have to add up the financing element over here. And this is something which we are going to add up like this over here, right? All right. So this is how we had these questions over here. Now, moving ahead from here, we are now going to look at the other questions, the section B type questions over here today, right? So let's start now. Here we go. The following scenario relates to questions 271 to 275. During the year, Darby started research work on a new processor chip. Darby has a past history of being particularly successful in bringing similar projects to a profitable conclusion. In addition to this, Darby spent 200,000 training staff to use the new equipment as well. Darby also developed a new online platform during the year, spending 100,000 a month evenly from 1st February to 31st October. Darby was unsure of the outcome of the project, but doubts were resolved on 1st May following a successful testing. So the platform was launched on 1st November 2025 and was expected to last 5 years. Darby's accounting assistant has read something which states that intangible assets are identifiable non-monetary assets without the physical substance. So which or two of the following relates to the items being classed as identifiable? Now, having been said, the identifiable means, you know, asset arising from some contractual rights or the obligations over here. And then the second one is identifiable means having the capability of being separated from the organization, right? So item must have a probable future economic benefits. No, identifiable means having this capability of being separated. Item must arise from legal or contractual rights. Okay, agreed upon. Item must have a measurable cost for all the items that has to be. And then items that must be separable. Yes, B and D are going to be the correct options over here. Identify the correct treatment for the items below. Training for staff, it's expensed out. Expenditure on the processor, it's chip. Now, if I go, in addition to spend 200, okay, staff. Research work was started on the new chip now. So expenditure on the processor chip is going to be expensed out as well because this is the research over here. Then, how much should be recorded in Darby's statement of profit and loss for the year ended 31st December 2025 in relation to the development of the online platform over here? So the amount that you have to spend in the development should be recorded in the profit and loss. Okay. So for the profit and loss, if I go up, I spent from February, I became confident on 1st May. So means February, March, April, 3 months. For 3 months, I wasn't sure over here, right? So I had this 100,000 thingy over here. So this is going to be okay. And the platform is launched on 1st November as well. So pure research, that's gonna be 300,000 over here. And then the amortization as well, because the product was launched in the November. So technically speaking, I became confident first May. So May, June, July, August, September, October, 6 months. That is 600,000. Life is 5 years. So 600,000 by 5 into 2 months. That's going to be 2 by 12. 600,000 by 5 into 2 by 12 is going to be 20,000. So the total is going to be 320,000. So the amount taken for the development is going to be 320,000 over here. All right. Now moving ahead towards 274. Which of the facts relating to the online platform are incorrect over here? So I had this online platform spending 100,000 a month evenly, and this was launched in 5 years. Okay. The online platform will be subject to annual impairment review due to the judgmental nature of the project. No, not the judgmental. We have a straight life over here. Once capitalized, the development cost should be held at fair value. No, they're normally held at the cost. Depreciation on any plant used to develop the platform should be capitalized as a part of the development cost. Yes, the cost incurred, it has to be. It has to be. Right? So this statement C for the third one is going to be the correct one over here because we are capitalizing the development cost. Huh? So the depreciation, if it's incurred, that's something which is related to that as well. So yes, that's going to be capitalized over here. Now, Darby acquired a patent with a 10-year life for 500,000 on 1st January 20x5. On 31st December 2025, management believed that the patent was less fully utilized than expected and determined the following as a part of the impairment review: potential sale proceeds, estimated disposal cost, value in use. So what is the value of the impairment loss in the year ended 31st December 20x5? So this is what we got over here. Cost is 500,000. Amortization is by 10. Yes, so carrying value is for 50,000 over here. Value in use is 480, and over here this is 380. So higher is 480. Carrying value still less, nil. No impairment loss. No impairment loss because the recoverable amount is higher than the carrying value. Carrying value is just 450 and this value in use is 480. So there is no impairment over here. It's okay. It's fine. Perfectly okay. Right? Okay. Then I have next question over here. Here we go. Here we go. Here we go. And here we go. A has a year end of 31st December and operates a factory which makes the camera chips for the mobile phones. It purchased the machine on 1st July for 80,000, which had a useful life of 10 years and is being depreciated on the straight line basis, time portion in the year of acquisition and disposal. The machine was revalued to 81,000 on 1st July 20x4. There was no change to its useful life at that date. A fire at the factory on 1st October 2006 damaged the machine, leaving it with a lower operating capacity. Okay. The accountant considers that A will need to recognize an impairment loss in relation to this damage and has ascertained the following information at 1st October 20x6. 1, 2, 3, 4. Now, in accordance with IAS 16, question 276, in accordance with IAS 16, property, plant, and equipment, what is the depreciation charge to A's statement of profit and loss in respect of the machine for the year ended 31st December 20x4? Now, we got the machine on 1st July for 80,000. Remaining life is 10 years. Proportionate charge in the year of acquisition and disposal. Then on 1st July, the machine has been revalued. So at 31st December 24, we have to talk about the depreciation charge over here. So 6 months, 6 months depreciation charge. That's going to be first 6 months depreciation charge. 80,000 by 10 into 6 by 12, 4,000 is going to be over here. Then next 6 months depreciation charge. That's going to be 81,000 revaluation. So 81,000, there's no change in the life. So technically speaking, 1 year is gone. So it's going to be 9 into 6 by 12. Again, that's going to be 4,500. So total is going to be 8,500 over here as the answer. 277. IAS 36, impairment of assets, contains a number of examples of internal and external events which may indicate that the impairment of an asset. Okay. So in accordance with IAS 36, which two of the following would definitely not be an indicator of the potential impairment of an asset over here? In accordance with IAS 36, which two of the following would definitely not be an indicator, of impairment? Okay, so a reduction in A is cost of capital. If the cost of capital is reduced, automatically the discount rate is going to reduce over here. So it's not an indication of impairment. So this is correct over here. Adverse changes in the economic performance. Yes, this is an indication. A significant change in the technological environment in which an asset is employed, making its software effectively obsolete. Yes, this is an impairment. Okay. The carrying amount of an entity net assets being below the entity's market capitalization. This is an impairment as well. Unexpected fall in the market value of one or more assets. This is an impairment as well. Okay, so we missed which of the following is not. Unexpected fall in the market value is an impairment. The carrying value of an assets being below. Oh, the carrying value is on the lower side. My bad, my bad. Carrying value is on the lower side, not on the higher side. Option D is the correct one. It's not an impairment because if the carrying value is less than the recoverable amount, it's fine. It's not an impairment. It's not an issue. If the carrying value is on the lesser side, it's not an issue over here. Okay. Then we have 278 over here. What is the total impairment loss associated with A's machine on 1st October 20x6 over here? Okay, so this is the machine. The carrying amount is 6,750. Okay, 0.2 is irrelevant. The machine could be sold in the current condition for a gross amount of 45. Dismantling cost is going to be 2,000 over here. So this is going to be 43,000 over here. And its current machine could be repaired for 3 years, giving it a useful figure of 38. So 43 is what we are going to take it up over here, and the carrying amount is 6,750. Carrying value 6,750. Yeah. And 43,000 is the recoverable amount. 43,000, right? Okay. So automatically the impairment is gonna be 17,750. 17,750 is going to be the impairment over here. Then we have 279 over here, which says the accountant has decided that it's too difficult to reliably attribute the cash flows to this one machine and that it would be more accurate to calculate the impairment on the basis of the factory as a cash generating unit. So, in accordance with IAS 36 impairment of assets, which two of the following are true regarding the cash generating units? What of the following are true? Cash generating unit to which the goodwill has been allocated should be tested for impairment every 5 years. No. Normally, the cash generating units are normally tested for the impairment annually, not 5 years. A cash generating unit must be a subsidiary. No, come on, cash generating unit is the smallest part. It's not a subsidiary thingy over here. There's no need to consistently identify the cash generating units based on the same type of the assets. No, we have to. A cash generating unit is the smallest identifiable group of the assets for which the independent cash flows can be identified. Absolutely true. The perfect definition. Assets in a cash generating unit should never be impaired below their recoverable amounts. True. They are not impaired below their recoverable amount. It's absolutely true as well. So D and E are going to be the option over here. Then on 1st July, it's discovered that the damaged machine is worse than originally thought. The machine is now considered to be worth less and the recoverable amount of the factory as a cash generating unit is estimated to be 950. Okay. We have the building plant, net current assets. So, in accordance with IAS 36, what will be the carrying amount of the ACE plant and equipment when the impairment loss has been allocated to the cash generating unit over here? So, we have a building, we have a plant. This is 500, this is 335, and this is 950. Carrying value is 1170. Recoverable amount is 950. So the impairment is 220, right? Now over here, 35,000 is the value. So 35 is going to be deducted from here. So we have the revised balance over here, which is 500 and 300. Now, the remaining impairment is 220 minus 35, which is 185. So for the building, it will be 500 by 800 multiplied by 185. This will be 300 by 800 multiplied by 185. Okay. Now, the next carrying amount of the plant and equipment. Okay. So we will have to 300 by 800 into 185. We get 69 more. So 300 minus 69, that is going to be 231 over here. Yeah, this is 800 over here. Remaining impairment is total was 220 over here, right? Okay. Oh, shoot. I forgot to give it to the goodwill as well. We had the goodwill over here as well, which was 85. So this has been charged to 85 as well. So remaining impairment is 35 minus 85. So 220 minus 35 minus 85. 100 is remaining. $231. No. That's going to be 300 minus this. So that is 337. How 337? Okay. Minus 37.5. 262,500. I had formula error over here. So the answer is going to be 262,500 over here. So this is going to be the correct answer over here. 262,500. Right? Okay. Done. Basically, I forgot to put in the goodwill first. Basically, I somewhere missed that it was written over here. So we are going to charge it against the goodwill. Then we are going to charge it against the relevant plant item over here. We will calculate the remaining balance over here. And then we will have it over here. Right? Okay. Now, let's just go to the next question, which is from the 296 onwards. And here we go. Give me a minute and we are starting. Okay, so we have this question over here. The following scenario relates to question 296 to 300. Now, on 1st October 26, Fino entered into an agreement to lease 20 telephones to its team of sales staff. The telephones are to be leased for a period of 24 months at a cost of 240 per telephone per annum, payable annually in advance. The present value of the lease payments at 1st October 26 is 9164. On 1st April, Fino entered into an agreement to lease an item of plant from the manufacturer. The lease required 4 annual payments in advance of 100,000 each commencing on 1st April 20x7. The plant would have a useful life of 4 years and would be scrapped at the end of this period. The present value of the lease payment is 350,000. The cost of capital is 10%. Now, 296. Which of the following applies the principle of faithful representation to the above plant lease agreement? Faithful representation is basically that, if we get the asset under the right of use asset now, so the faithful presentation is that, if we have the risks and rewards with us as well, we have the right to direct the use of the asset and the asset is identified as well, then we have to record it as an asset. And we have to record it as an asset in the financial position to reflect the control, basically. So the correct option straight away over here is going to be the C over here, right? Then how much should be charged to the Fino statement of profit and loss in respect of the telephones if the Fino applied the exemption permitted under IFRS 16. Now, if I go with as far as the exemptions are concerned, this is something which we all are aware that the short-term lease period exemptions are basically available to us, where we can exempt it from capitalizing it up is concerned, where the lease period is normally for 12 months or less, right? Or the assets have a low value. So, as far as the low value is concerned, this is something on which the standard is silent, but it gives the examples, including the telephones as well. So in this case, the lease rentals, they have to be charged as an expense within the statement of profit and loss over here. So if I go up, the amount which we have to pay is 9164. So we got it on 1st October, right? And the telephones are leased to be paid for a period of 24 months at a cost of 240 per telephone per annum, right? So this is the present value of the lease payment at 1st October is going to be 9164 over here, right? So in this case, the amount that you can go and record over here is 9164 multiplied by, just calculate the present value over here, right? The present value is going to be 1.1 whole raised to power minus 2 over here, because it has been leased for 2 years, huh? So 9164 into 1.1 whole raised to power minus 2. So this is going to be 7574 over here. Okay, otherwise we have we don't have this option over here, by the way. 7574. No. If I straight away take up 240 per telephone, how many telephones are there? 240 per telephone per annum. Okay. So this is 9164 over here. If we see over here, we have 20 telephones that we have to rent out, right? So we can simply say these are going to be the 20 telephones multiplied by the rental 240 per phone. So that's gonna be 4800 over here is the answer straight, right? Whatever the number of phones that you have, the rentals that you're gonna pay, they are going to be included over here. So what would be the carrying amount of the right of the use plant at 30th September 20x7? The carrying amount of the right of the use plant. This is the right of the use plant. Okay, so we got it on April. Carrying value is what we have to find, right? Okay. So the present value is 350,000 over here. 350,000. We are going to have 4 annual payment in advance. Life is 4 years, right? So this is going to be 350,000 by 4 into April to this is going to be 6 by 12 by 4 into 6 by 12 is going to be 43,750 over here. So 350, 1, 2, 3 minus this, we get 306 over here. So 306 is going to be our answer over here, this one. Right? Okay. Then, what interest would be charged to Fino statement of profit and loss for the year ended 30th September 20x7? in respect of the plant lease. So if we lease the plant, 4 annual payments on 1st April 2027, so 350,000 minus 100,000, we have 250,000 multiplied by 10%, we get 25,000 over here, right? This 25,000 is for the year, so 6 by 12, we get 12,500 over here. This is going to be the answer. Here we go. And 12,500 is going to be the answer. Right? All right. Then applying the principles of IFRS 16 to capitalize the plant, recognize the liability would have impact on the following ratios. So if we would have accounted it for return on capital employed is profit before interest and tax divided by capital employed. Capital employed is equity plus debt. So if we record the plant over here, the debt portion is going to increase. So debt portion increased, our return on capital employed is going to decrease. Gearing is debt over equity plus debt. Debt has increased, so the gearing is going to increase. Interest coverage, because the debt has increased, the interest has increased. So technically speaking, the profit is going to be on the lower side. So the interest coverage is going to drop over here as well, right? So this is what we have. Then let's just go to the next question now. On 1st January 2026, Lotso entered into an agreement to lease a new machine under a 5-year lease with 300,000 payable on 31st December each year. Right? Now, the interest rate, asset has a useful life of 6 years and ownership of the asset is going to be transferred at the end of the lease. So technically speaking, the life is going to be 6 years, which we are going to use for the depreciation. The interest rate implicit in the lease is 6% and the present value of the lease payment is 1,263,000 over here. Now, on 1st January, Lotso sold its head office to a finance company, but continued to use the head office for the remainder of its 20-year estimated useful life under the lease agreement. The carrying amount of the head office on the 1st January was 10 million and the fair value of the asset and sale proceed was 11.5 million. So, how would the finance cost in respect of the machinery lease for the year end is going to be? Right? So this is the new machinery payable on 31st December, and interest rate is 6%, present value is 1,263. So 1,263,000 multiplied by 6% is 75 over here is what we have. 75,780 is what we are going to have over here as the answer. Now, what is the current liability to the nearest thousand that has to be recorded in also in relation to the machinery lease? In relation to the machinery lease, the current liability portion, for this we have to create the schedule, number of years, liability at start, payments are at year end, so we are going to have the interest, total, repayment, and then the liability at year end. So liability at start is 1,263,000. Interest is 6%. Total is the sum. Repayment is 300,000. And then the liability at year end is this one. Then same amount here, same amount here, same amount here, here, and here. Now the difference between these two, is going to be the current liability, that is 1,038 780 minus 801 107 237 673 over here. So this option B is going to be the one over here. To the nearest thousand. Okay, okay, to the nearest thousand. This one, see, to the nearest thousand now. So this will be rounded off to 270, 238, sorry. This is rounded off. Then, what is the carrying amount of the right of the used machinery asset at 31st December? Carrying amount of the right of the use of machinery at 31st December 20x6. This is the machinery, has to be divided by 6 years because the title has been transferred. So 1263000 by 6 is, this is the depreciation charge. So 1263000 minus 210 500 1052. Here we go. Right? All right. So this is what we are going to have over here. Then what would be the carrying amount of the head office over here? Now, as far as for the head office is concerned, head office has a value of 10 million. We are going to use it for the whole time. So this is a secured loan over here. And the remaining life is 20 years, simply 10 by 20. Right? So 10 million by 20 years. That's going to be 500,000 over here. This is what we are going to have over here as the answer. 9,500,000. This is the answer. Identify the statement below are true or false. Statement 1. In a sale and leaseback transaction, no profit will be recognized by the lessee. No, the profit is recognized by the lessee by the amount or by the proportion of which the rights have been surrendered. So this statement is false. In a sale and leaseback transaction, the sale proceeds will usually be treated as a loan to the lessee. No, it's not necessary. I mean, if it's the lease for a shorter period or something, then it's not a loan. So this statement is false as well. Right? All right. So this is what we have for today. I am going to stop over here now. We are going to resume from the same very point from tomorrow when we're going to come, and then we'll start off with the other questions as well. So let's just have a pause over here. Now, today we have covered the intangible assets along with the impairment, and then we have talked about the lease and the revenue as well. All of these standards, including the impairment, these are really very important, and you can expect straight away a question in the section A and in the B, and some adjustment in the section C as well. Prepare well, practice well, right? And tomorrow we are going to meet again, and what you have to do is just go through the recordings again, right? So that you have gone through the basics as far as the theoretical area is concerned, so that you have a sound base of what you have learned. And then obviously, tomorrow when we're going to come over here, we will do the practice from the exam kit so that our grip is strengthened towards as far as our topics and everything is concerned. Right? So this is all from my side. I am going to see you again tomorrow, same time, same place, same channel. Till then, take care of yourself, your family, friends, and the people around you. Have a lovely time ahead of you till we meet again. Take care. Bye bye.